There's been a lot going on in the stock market in these first few months of 2026. The huge growth that we saw in tech, growth, and AI stocks has really started to weaken, and the market has really started to make a transition to more value and defensive names. And in this video, I'll be talking about 7 of the best value ETFs for 2026 to help you further diversify and better balance your ETF portfolio. Quick reminder, this video is for educational purposes only. This is not financial advice, and I'm not a financial advisor. All investments carry risk, so always be sure to do your own research before making any investment decisions. Let's first talk about what's the case for value stocks in 2026. Over the past few years, growth and tech stocks were heavily driving the overall growth in the stock market. Between the Mag 7 companies, other AI-related names, and semiconductors rallying on strong earnings, the steady flow of good news, and high expectations driving many growth names to high valuations. But the rotation into value stocks have been a pretty strong theme for 2026, highlighting the change in investor sentiment after years of growth dominating. We have an overhang of macroeconomic uncertainty, with the labor market continuing to weaken, conflict in the Middle East, and possibly reigniting inflation, lowered rate cut expectations, concerns around heavy AI spending, and much more. This is causing investors to reduce or shift away from tech exposure and higher risk assets and look towards companies and sectors that are less vulnerable to market uncertainty, with more attractive valuations and steadier cash flows. Now, this doesn't mean that it's doom and gloom for tech or AI-related companies, since there is the possibility that things could reverse. But if the uncertainty does remain in 2026 or the macro environment gets worse, these value ETFs are going to be leading the way. And if things turn around at some point in time, then these are still some great funds to invest in with solid holdings. So let's get right to the funds. This first group of ETFs are going to be large cap value funds. While these funds are grouped together here, they each track different indexes and have different strategies. So first up is VTV, the Vanguard Value ETF. This fund tracks the crisp US Large Cap Value Index, which includes companies that make the top 85% of the US stock market with value characteristics. To choose its stocks, it uses a value scoring model based on metrics like price to book ratio, price to earnings or PE, forward PE, dividend yield, and price to sales ratio. And the index is reconstituted and rebalanced every single quarter. As for the portfolio of VTV, this ETF currently contains 312 stocks, with top holdings in names like Berkshire Hathaway, JP Morgan, ExxonMobil, Johnson & Johnson, and Walmart, which make up a little over 20% of the portfolio. The sectors VTV is mostly exposed to are financials, industrials, and healthcare, with the remaining percentage spread in a few other sectors. And you can see tech exposure is pretty minimal. Getting to the fees, VTV has an expense ratio of 0.03%, costing you $3 yearly per $10,000 invested. And the dividends aren't too bad, as it comes with a dividend yield of about 2%, which it pays out quarterly. While the performance of the overall market has been strong over the past few years, VTV has done well with 5-year annual returns of 13.5% and annual returns over the past 10 years of just over 13%, which is hard to complain about. VTV gives you a diversified portfolio of blended value, and it has a solid track record of over 20 years, a nice dividend yield, and lower volatility than the overall market. This can make it an attractive choice in today's uncertain economic environment, especially for those investors that are looking for exposure to solid companies beyond the tech sector that come with some stability and margin of safety. Next up, we have schv, the Schwab US Large Cap Value ETF. This fund tracks the Dow Jones US Large Cap Value Total Stock Market Index, which includes large cap companies with value characteristics. The value stocks selected for this index are based on 6 different measures: 2 projected, 2 current, and 2 historical. This includes projected price to earnings ratio and projected earnings growth, price to book ratio and dividend yield, then trailing revenue growth and trailing earnings growth. And the index is rebalanced quarterly and reconstituted once a year. The portfolio of schv is made up of 558 holdings in total. And the top holdings are in companies like Berkshire Hathaway, Johnson & Johnson, AbbVie, Home Depot, and more, which combined are a bit under 20% of the fund. And the sectors that schv is exposed to include financials, industrials, technology, and healthcare. So it's not heavy in the top holdings, and it has a nice spread of exposure to a variety of companies and sectors. Now, if you didn't notice, schv is pretty similar to VTV as those top holdings are almost exactly the same, with SHV having a little bit less weight. The index methodologies are slightly different, and SHV is going to give you over 200 more stocks, so you could say it's more diversified. SHV is also another low-cost fund with an expense ratio of 0.04%, costing $4 per $10,000 invested. And it has a dividend yield of nearly 2%, which is paid out quarterly. As for the performance, SHV has had 5-year annual returns of over 11.5%, and annual returns over the last 10 years of about 12%, which is solid. This ETF can be a good option for those investors that want to transition or reduce their concentration on mega-cap tech stocks while still getting exposure to more defensive names and strong stocks. And compared to other large-cap value funds, SHV still manages to have good returns while giving you exposure to a lot more stocks. The third large-cap fund we have is MGV, the Vanguard Mega Cap Value ETF. This fund tracks the CRSP US Mega Cap Value Index, which invests in the largest value companies in the US stock market. So unlike VTV and SHV, which are made up of large cap value, MGV is essentially a chunk of those ETFs since it's focused solely on mega cap names. This index is very similar to VTV with the exception that it's focused on mega cap stocks. So it uses the same value scoring model based on measures like price to book ratio, price to earnings or PE, forward PE, dividend yield, and price to sales. And also the index is reconstituted and rebalanced every single quarter. Moving to the portfolio, MGV currently has 123 holdings, with top holdings in stocks like JP Morgan Chase, Berkshire Hathaway, ExxonMobil, Micron Technology, and Costco, which make up a quarter of the portfolio. For the sectors, financials is the largest, then healthcare, industrials, consumer staples, and technology. The top holdings are similar to VTV and SHV, but there's a little more weight allocated to those mega cap names. You also see a slight increase in some of the exposure to the larger sectors as well, but keep in mind this is a mega cap fund, so it'll be more concentrated in nature than the other two funds. For the fees, MGV has an expense ratio of 0.05%, costing $5 per $10,000 invested. And for the dividends, it comes with a dividend yield of 1.97%, which is paid quarterly. And for the best part, the returns, MGV has had 5-year annual returns of about 14% and annual returns over the last decade of over 13%. The mega cap concentration has allowed this fund to squeeze out some even better returns. And if you're an investor that likes the idea of a mega cap focused fund with great returns, stable companies, and a solid dividend yield, then MGV is one to keep on your radar. This next group of value ETFs have the added benefit of higher dividend income. This first one is pretty well known, and that's schd, the Charles Schwab US Dividend Equity ETF. This fund tracks the Dow Jones US Dividend 100 Index, which invests in companies that have a history of paying and growing dividends. This is the index with a very selective filtering process. It requires companies that have at least 10 consecutive years of dividend payments, a market cap of at least $500 million, and a minimum average daily trading volume of $2 million, along with other filtering measures like return on equity, indicated annual dividend yield, 5-year dividend growth rate, and more. And the index is rebalanced quarterly and reconstituted every year in March. For the portfolio of SHD, this fund contains 101 holdings, with top holdings in stocks like Lockheed Martin, ConocoPhillips, Chevron, Verizon, and more, with its sector exposure mostly in energy, consumer staples, healthcare, and industrials. While there is a tilt towards energy, there's still diversification across defensive and value names. Now, I do want to say, by the time this video is posted, SHD has likely had its reconstitution, so I'm sure the top holdings and sector exposure changed by quite a bit. But I didn't want to kick out this fund from the video just because this part would change. Now for the fees, SHD has an expense ratio of 0.06%, costing $6 yearly per $10,000 invested. For the dividends, it has a solid dividend yield of 3.4% that's paid quarterly. And its consistency is top-notch with 14 years of both consecutive dividends and dividend growth, making this a powerhouse when it comes to dividends in general. Shifting to the performance, SHD has had 5-year annual returns of 11% and annual returns over the last 10 years of over 13%, which is good and steady returns for this dividend fund. For value ETF, SHD is different from the others since it's so strict in its selection criteria that also prioritizes some dividend metrics. And this strategy is important since this is what you're investing in when it comes to SHD. It does have higher turnover since there can be some large changes in the holdings when it comes time for its reconstitution, so don't expect it to have many of the same stocks year in and year out. Either way, schd gives you exposure to value stocks and it leans away from the big tech names, which can make it a nice plus when building a well-rounded portfolio. And if you want a solid dividend fund with consistent dividends and good long-term returns, schd is definitely one to consider. Next up is vymi, the Vanguard International High Dividend ETF. This fund tracks the FTSE All-World ex-US High Dividend Yield Index, which contains international stocks that are expected to have above average dividend yields. And the way that this index functions is pretty straightforward. It excludes companies that haven't paid dividends in the last 12 months or aren't expected to in the next 12 months. And it cuts out real estate investment trust or REITs. And then it ranks stocks based on expected dividend yield and selects the top 50% of stocks to put in its portfolio. Speaking of portfolio, vymi has 1,532 stocks, with top holdings in names like Roche, Novartis, HSBC, Nestle, Shell, Toyota, and more, making up under 15% of the total portfolio. The sectors it's primarily exposed to are financials, which makes up a big chunk. Then the remaining is spread in industrials, energy, basic materials, consumer staples, and a handful of others. Something to note is that it's pretty heavily tilted in financials, while the rest of the sectors are pretty well balanced out. Like typical Vanguard funds, the expense ratio is low at 0.07%, costing $7 yearly per 10,000 invested. And for the dividends, vymi has a pretty nice dividend yield of 3.5%, which is going to be paid out quarterly. International stocks outperformed the US market in 2025 and have been strong coming into 2026. And vymi has had 5-year annual returns of almost 15% and annual returns in the last 10 years of over 11.5%. And in just the last year alone, vymi had returns of right around 45.5%, which is pretty amazing. An international fund can be a great way to increase the diversification in your portfolio and lower the overall risk by having exposure outside of the US market. And while we currently have a conflict that's affecting both the US and international markets, which hopefully resolves in the short term, the international market still has some attractive valuations and solid opportunity for growth. This next group of ETFs goes beyond the more traditional large cap value ETFs that we first talked about. So these funds will not only expand your diversification, they also have some pretty unique strategies. First up is going to be avuv, the Avantis US Small Cap Value ETF. This fund invests in a broad range of US small cap companies and focuses on companies that the management believes to have low valuations with higher profitability. Unlike all the other funds on this list, this ETF is actively managed, so the managers are buying and selling assets based on the standards and requirements of the fund and the market environment. Also, if you weren't aware, small cap stocks have more growth potential than large cap stocks, but the trade-off is that they're more volatile. For the portfolio, avuv has around 775 holdings, with those top holdings being Viasat, Five Below, SM Energy, Matson, Macy's, and more, which make up less than 10% of the portfolio. So no holdings carry too much weight in the fund. And for avuv's sector exposure, financials is up top, then consumer discretionary, energy, industrials, and the remaining percentage spread in a few other sectors. The expense ratio of avuv comes in at 0.25%, costing $25 per $10,000 invested. And that slightly higher fee is going to be because it's actively managed. For the dividends, it has a dividend yield of 1.4%, which is paid quarterly, so nothing too special here since it's a fund focused on small cap companies. For the performance, avuv has had annual returns of around 12.7% in the last 5 years, and annual returns of just over 15% since it was created in September 2019, which well outperformed the Russell 2000 Value Index. The valuation difference between small caps and large caps is still pretty big, with small caps offering some nice valuations. This usually provides good opportunities for growth potential, especially since some would say large cap valuations are a bit stretched. But this doesn't take away the fact that these funds do carry more risk than their large cap counterparts. Small cap stocks are rate and inflation sensitive, and given the current market conditions, it's hard to say in the short term what might happen. But if we get back on track with rates coming down, cooling inflation, and a positive economic environment, there is some solid potential here. Small cap exposure can be a great way to boost the diversification and growth potential of your portfolio, and if it sounds like something that's right up your alley, then avuv is one to keep your eye on. The second fund is VLU, the Spider S&P 1500 Value Tilt ETF. The objective of this fund is to match the performance of the S&P 1500 Low Valuation Tilt Index. And this index overweights stocks with relatively cheap valuations and underweights stocks with relatively high valuation. And the index uses a variety of measures like price to book ratio, price to earnings ratio, price to cash flow ratio, price to sales ratio, and dividends paid. Then it places them in 20 buckets of roughly equal market cap based on valuations. And the cheapest bucket gets the highest weighting factor in the portfolio. And also, the fund is rebalanced and reconstituted annually in April. The portfolio of VLU is made up of 1,444 holdings, with top holdings in companies like Amazon, Exxon, Google, Walmart, and Verizon, which make up less than 20% of the fund. The sectors VLU is mostly exposed to are financials, technology, healthcare, industrials, and consumer discretionary, which is a pretty diverse spread of holdings and sectors. And while it contains names like Google, Amazon, Microsoft, and others, they make up a small percentage and are balanced out well with a variety of other holdings. As for the cost, VLU has an expense ratio of 0.15%, costing $15 per 10K invested, which is still cheap. And it has a dividend yield of 1.7%, which is going to be paid out quarterly. And this ETF won't let you down when it comes to the performance, with 5-year annual returns of 13.5% and annual returns over the last 10 years of just about 14.5%, making this not only the most diversified out of the bunch, but also one of the best performing as well. What's unique about VLU is that as a value fund, it doesn't abandon some of those growthier names due to the strategy of the index. And since it gives you exposure and balance to strong value names with a sprinkle of growth, I believe this gives you an advantage when the market rotates more towards growth. It's also going to be giving you exposure to small, mid, and large cap stocks, which is something many of the other funds miss out on. And if you're an investor that's looking for a solid value fund with great returns, a solid strategy, and diverse holdings, VLU is one to keep in mind. And if you're looking for more options for solid and stable ETFs, I go over some of the best dividend ETFs to invest in this video here. Or if you want to see the best one ETF portfolio to buy and hold forever, then watch this video here. If you got some value from this video, be sure to tap that like button and subscribe for more content. Keep on investing, and I'll see you in the next one.